You are standing at the threshold of your adult life. The year is 2026. You are 18 years old, clutching a high school diploma that feels more like a receipt than a ticket to the future. Your bank account balance is a modest 3 figures, and your primary asset is something you cannot see, touch, or feel: time. At 18, time is an invisible ocean. You feel like you have an infinite supply of it, so you treat it with the carelessness of someone who thinks the well will never run dry. This is the fundamental error of the human condition. We do not value what we have in abundance until the scarcity begins to show. To understand the gravity of the decision you're about to make, we have to look at two versions of you. We will call them Path A and Path B. They are identical in every way. Same hometown, same average intelligence, same entry-level job at a local distribution center. The only difference is 7 years. 7 years sounds like a blip in a 70-year life expectancy. But in the world of compounding, 7 years is the difference between a life of quiet luxury and a life of perpetual noise. Path A begins at age 18. We will call him the architect. On his first payday, he receives a direct deposit of $1,400. After his modest expenses, living with his parents, driving a paid-off 10-year-old Toyota, and skipping the $15 cocktails his friends are starting to buy, he finds himself with a $500 surplus. He doesn't see this $500 as fun money. He sees it as a workforce. He opens a brokerage account on a Tuesday evening while his friends are playing video games. He clicks a button that authorizes an automated transfer of $500 every month into a low-cost S&P 500 index fund. He doesn't know much about the stock market, but he knows that the largest 500 companies in America are better at making money than he is. He sets the dividend reinvestment to on, closes the laptop, and goes to sleep. For the next 7 years, this is his ritual. He doesn't check the balance during market crashes. He doesn't brag about it at parties. He simply treats that $500 as a tax he pays to his future self. It is a non-negotiable expense, like electricity or water. Path B begins at age 18 as well, but we will call him the experiencer. He receives the same $1,400 paycheck. But Path B believes in the philosophy of YOLO, you only live once. He looks at his bank account and sees $500 of freedom. He signs a lease on a brand new Ford F-150 because the monthly payment is exactly $480. He tells himself he needs a reliable vehicle for work. He spends his weekends at festivals, buying rounds for friends, and upgrading his wardrobe He isn't a bad person. He isn't even irresponsible by society's standards. He pays his bills on time. He just doesn't invest. He tells himself, I'm only 18. I'll start being serious when I'm 25. 25 is when real life starts. For the next 7 years, Path B builds a mountain of memories and a valley of depreciating assets. He has 40,000 miles on a truck that is worth half what he paid for it, and his retirement balance is a literal zero. He is happy, or at least he thinks he is, because he is surrounded by the noise of consumption. By the time both men reach age 25, the divergence is already staggering, though it remains invisible to the naked eye. Path A, the architect, has been investing $500 a month for 84 months. His total out-of-pocket contribution is $42,000. But because he started at 18, the market has had time to breathe. Assuming a standard 10% annual return, his account has grown to approximately $61,000. At age 25, the architect makes a radical decision. He decides he has done enough. He has met a girl, he wants to buy a house, and he wants to shift his focus. He stops his $500 monthly contributions entirely. He never adds another dollar to that brokerage account for the rest of his life. He leaves the $61,000 alone, letting it sit in the cold, dark vault of the S&P 500. He has only sacrificed for 7 years. Now, look at Path B, the experiencer, at age 25. He has his quarter-life crisis moment. He realizes he is a quarter of a century old with nothing to show for it, but a thinning tread on his tires and a closet full of clothes that are out of style. He decides to become a warrior for his finances. To make up for lost time, he commits to investing $1,000 a month, double what Path A ever contributed. He sells the truck, moves into a smaller apartment, and begins his journey of discipline. He is now working twice as hard as Path A ever did. He feels superior because his monthly contribution is so high. He watches his balance grow from $0 to $12,000 in the first year. He thinks he's winning, He thinks he has caught up, but he is fighting against the most powerful force in the universe, the head start. Let's fast forward 15 years. Both men are now 40 years old. Path B has been a machine of consistency. For 15 years, 180 months, he has funneled $1,000 into the market without fail. He has invested $180,000 of his own hard-earned money. He has missed vacations, worked overtime, and lived a life of extreme frugality to maintain this pace. At age 40, with a 10% return, Path B's account has grown to roughly $415,000. He feels like a titan of industry. He sits down for coffee with Path A, who hasn't talked about money in a decade. Path B brags about his $415,000 balance. Path A pulls up his app, the one he hasn't contributed to since he was 25. Path A's $61,000, left untouched for 15 years at a 10% return, has ballooned to $255,000. Path B is confused. I put in $180,000 and you only put in $42,000. Why am I only ahead of you by a small margin? The answer is the cost of the 7-year gap. Path B had to work 4 times as hard just to barely surpass a man who quit 15 years ago. But the story doesn't end at 40. The true cruelty of the math reveals itself as they approach 65. Path A continues to contribute nothing. His $255,000 at age 40, left alone for another 25 years, turns into $2.7 million. Path B, even if he continues his $1,000 a month grind until 65, will end up with approximately $2.4 million, despite investing 3 times more principal and working 30 years longer than Path A. Marcus, Path B, can never catch the ghost of the 18-year-old version of Alex, Path A. He is a victim of the calendar. This script isn't about numbers, it's about the psychology of the quiet builder. When you start at 18, you are building a system that requires less effort over time. When you start at 25, you are building a system that requires more effort just to maintain a baseline. Path A at age 30 isn't rich, but he is math rich. He can afford to take a lower paying job that he loves because his retirement is already solved. He can afford to be a better father because he isn't stressed about the what-ifs of old age. Path B, however, is perpetually stressed. He feels like he's running on a treadmill that keeps speeding up. He's making $100,000 a year now, but because he started late, he has to keep that high-stress job just to keep his investment momentum alive. He has no optionality. Think about the lifestyle of Path A in his 30s. Because he doesn't need to save for retirement anymore, since his seed is already planted. He can actually spend more of his paycheck than Path B. Path A can take his kids to Disney World using the money that Path B has to put into his 401k. This is the ultimate irony of financial discipline. The earlier you start, the more irresponsible you can be later in life. Path B is living a life of delayed gratification that never seems to end. He delayed it at 18, and now he is forced to delay it at 35, 45, and 55. He is chasing a finish line that Path A crossed before he could even grow a beard. Consider the impact of a market downturn. When the market drops 30%, Path A doesn't care. His cost basis is so low from his contributions at 18 that he is still deep in the green. He views the crash as a spectator. Path B, however, sees the crash as a personal attack. Because he is putting in $1,000 of his current hard-earned labor every month, a 30% drop feels like his actual life energy is being erased. He is more likely to panic sell. He is more likely to give up. The 18-year-old starter has a psychological moat that the 25-year-old starter can never build. The distance between these two lives is measured in more than just dollars. It is measured in the quality of sleep. It is measured in the ability to say no to a toxic boss. It is measured in the Tuesday afternoon test. The Tuesday afternoon test is simple. Can you walk away from your desk at 2 p.m. on a Tuesday just to go for a walk, without worrying about your bank balance? Path A passes this test by age 35. Path B might not pass it until 60. All for the sake of 7 years of fun in his early 20s. Was the brand new truck at 19 worth 25 years of extra labor? Was the extra round of drinks at 21 worth the inability to retire at 50? As you listen to this, you might be 21, 25, or even 30. You might feel a sense of regret. But the math offers a second lesson. The best time to plant a tree was 20 years ago. The second best time is now. If you miss the 18-year-old window, your tax is simply higher. You have to be the warrior that Path B was. You have to accept that you will have to work harder than the 18-year-old version of yourself would have. You have to automate the system today, not because it's easy, but because it will never be cheaper than it is right now. Every day you wait is a day you are stealing from your older self. You are essentially taking a loan out against your future freedom, and the interest rate is higher than any credit card on the market. Imagine your life at 50. Path A is sitting on a porch. He hasn't thought about the S&P 500 in years. He doesn't know what the market did today, and he doesn't care. He is wealthy in the only way that matters. He owns his time. Path B is in a boardroom, checking his phone under the table, watching the red and green candles of a stock chart, praying for a bull market so he can finally stop. They both started at the same logistics firm. They both had the same $1,400 paycheck. But one of them understood that at 18, you aren't just buying stocks. You are buying minutes, hours, and years. The other thought he was just buying a truck. The system you build at 18 is a building system. The system you build at 25 is a recovery system. Both systems compound. Both systems will define who you are when the hair turns gray and the joints start to ache. Choose the building system. Open the account. Set the automation. Then, forget it exists. The most successful investors are the ones who have the discipline to be boring. Be boring at 18 so you can be legendary at 50. Don't be the man at 40 who is working twice as hard to get half as far. The math is ready when you are. The ocean of time is waiting. But remember, the tide only goes out once.